Welcome back to Exiles Market. When buying options, picking the correct strike and expiration date can be confusing. Let's walk through how to analyze a stock option. I'm using Robinhood, but all brokers are going to have a trade options button. Click that and you'll come to a screen with all of the basic option information on it. You're going to have the current price of the stock somewhere in the middle. You're going to be able to select whether you want calls or puts, whether you're buying or selling, and usually a drop down with the expiration dates listed. The strike prices over here on the left are usually going to be in list form because they correspond with the premium, how much these contracts cost to purchase or how much you'll get in premium if you sell them. Now, everything below this price line, this share price here, is in the money. And everything that is above the share price is out of the money. Why do we call it that? Well, because when you buy a call, you have the right, but not the obligation, to purchase 100 shares at the strike price. So if I have a contract that, let's say the strike is $66, this contract is giving me the right to purchase the stock at $66, turn around and sell it at the market value of 69, making me about $3 per share. I'm making money. I'm in the money. Now, above the share price, these strikes, well, it wouldn't make sense to exercise these options. There's no way I'm going to pay $72 per share to exercise this option when I can just buy the shares at market right now for $69. So we call these options, everything above here, we call these out of the money. Now, buying a call is always a bullish move. So the whole idea is to either exercise the option, buy at a low strike, sell at the higher market price, or once the stock moves in price, sell the contract back to the market. So that's your first decision. You need a stock that you are bullish on. The next decision is going to be the expiration date. If you're bullish on Coca-Cola, you probably already have a rough idea of what this time frame is. 2 weeks because they have a launch of a new product, or maybe the company is undervalued right now and you feel 6 weeks from now they are going to recover. Whatever that time frame is, that's your rough idea of what you want to start for expiration. For this demo, let's assume Coca-Cola is going to move in the next 2 weeks. So I can come here and pick the February 28th date. Now you need to pick a strike. And the very first thing you need to consider is risk versus reward. The lower strikes have higher premiums. You can see 68, 69. You can see these as we go down, the premiums are higher. $355 for this one, $450 for this one. Now, also, these contracts are going to have fast gains and they're going to have fast losses. The higher strikes, these up here, they're going to cost less. Look at this. This one is $23. This one is $10. They are lower cost, they're lower premiums, and they have slower moving gains and losses. So, how much are the gains and losses? For that, we need to look at the Greeks. Let's say I'm very confident that Coca-Cola is going to increase in value and I want to maximize returns. Let's say I'm comfortable spending a little bit more money. I might look at this $66 strike. If you click the row, you're going to get an additional information. And this is where we're going to find the Greeks: delta, gamma, theta, vega, and rho. I did a whole video covering the Greeks in detail, so please go check that out. Delta tells us that this contract is expected to or should gain or lose about $90 for every $1 that Coca-Cola changes in value. Now remember, options are sold in blocks of 100 shares, so you need to multiply this 91 cents by 100. So I'm paying a lot up front to buy this contract. $350. And I'm getting a lot of movement. I'm getting 91 cents right now, 91 cents per $1 that Coca-Cola changes in price. Contrast this with a higher strike. Say I pick this $73 strike right here. Now you can see that the delta is 4 cents. I'm going to pay a lot less for this option. Right now I could buy this option for $6, and when the stock moves $1, I'm only going to gain or lose $4. And that makes sense. Because do we really think Coca-Cola is going to close over $73 by the expiration date, 15 days from now? Maybe, but there's a good chance it won't. because it only has 15 days to make this move. So there is a higher probability that this $73 call option is going to expire worthless. That's why it's cheaper to buy, only $6, and that's why the gains and losses don't move as much. Then, of course, I could pick something in the middle. So if I were to take a look at this $70 option here, it's going to cost me $50, and it's going to move 36 cents per dollar that the stock moves. Or I could look at this $69 option. I could buy this one for $100, and I can see that it is going to move approximately $57 for each $1 that Coca-Cola would move up or down. If we change the expiration date out further, let's choose something that is about a month away, March 14th. You can see that this $73 option now costs a little bit more. Now it is $12 to buy this. And take a look at the delta. The delta is also increased. So this contract is going to move by $9 for every dollar that the stock would move in price. And why is that? Well, that also makes sense because now, when we were saying before $73, Coca-Cola may not reach that in 15, 14 days. But now it's got a lot more time to do it. So now it's got 29 days to make that move, which means there's a higher probability that this call right here is going to be in the money at expiration date. Now, again, you don't have to hold these contracts to expiration. At any time, if the contract has gained or lost value, it doesn't matter if the contract is in the money or out of the money, you have the option to sell these contracts back to the market. Now that we have our stock that we're bullish on, we've picked a strike, we know what our expiration date is, let's take a look at the data in a little bit better format. This is optionstrat.com, and this is a great website for viewing what your contract is going to look like over time. Now, I've done a whole video on Option Strat on all of the options that you have within this website. For this demo here, we're just going to keep to the basics. Right now, you can see that we have our call sign here, Coca-Cola. It will give you the current market price, $69. And we've entered a call, a buy call for $66 on the strike. And it will tell us exactly what it's going to cost to enter this trade, what it's going to cost to buy this contract, $340. And then this graph down here is going to show you over time, over the next 2 weeks, because we've picked an expiration date 2 weeks from now. It's going to show you every single day what is going to happen to this option contract depending on what the stock price does. On February 21st, if the price of Coca-Cola is $70, so about a dollar more, you can see on the 21st of February that we would have $146 in profit. That's how much profit we would have. The green here is what it is going to increase in value. Now, if Coca-Cola loses value, say on the 21st of February, the stock price is $68, you can come over here and you can see that it will be worth $126 less than what it is right now. So this will give you a really good idea by the time this contract expires on the 28th, where it is going to be and how much money you would stand to make or lose. To open up this contract, it's going to cost you $340. So that's your max loss. You can see that anything under that $66 strike right here is going to be a total loss at the time that it expires. That makes sense because it would expire out of the money and it would expire worthless. You can also see that the price of this option increases when the stock also goes up. You can use this slider to give a different range. So if I wanted to see a smaller range or I wanted to push this all the way over and see what would happen with my contract if the stock ended up being $68, you can see that it would be $860 at expiration. This is a great tool to determine what is going to happen what should happen day by day to your option contracts. The best way to become a better trader is to ask questions and observe what other successful traders are doing. So if you have questions, put them in the comments below, or come check out our Discord. Myself and other experienced traders are there every single day helping people level up their trading game. Thank you, and I hope to see you in the next video.